Hi everyone, welcome back to the Wise Elephant Finance journey. Today we are going to break down the essential do's and don'ts of investing to help you make smart choices for your money. Whether you're just starting out or looking to refine your strategy, this guide is for you. Investing can seem like a dense jungle sometimes, but with the right map and understanding, it becomes a path to financial growth. The do's, smart steps for your investments. Let's dive into the do's. These are the foundational practices that support a healthy and successful investment strategy. Think of these as the sturdy pillars holding up your financial future. Number 1. Do invest consistently. Think of it like building a house brick by brick. You don't just build it all at once, right? Consistent investing means regularly putting money into your accounts, whether it's bi-weekly or monthly. This isn't just about putting money in, it's about building a powerful habit. Why is consistency so crucial? Well, it introduces you the concept of dollar cost averaging. Imagine the stock market as roller coaster, it goes up and down. If you invest a fixed amount regularly, you will naturally buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your purchase price, reducing the risk of buying everything at a market peak. It takes the stress out of trying to time the market, which we'll talk about later. For example, let's say you invest $100 every month. In some months, the market might be down and your $100 buy more shares. In other months, it might be up and your $100 buys fewer shares. But by consistently investing, you're always participating, always building, regardless of the short-term market noise. This steady approach helps you build wealth over time and smooths out the inevitable ups and downs of the market. It's about being reliable with your contributions, creating a steady stream of growth for your future. Number 2, do automate your investing. Following on from consistency, this is your secret weapon for making it happen. Make it easy on yourself. Set up automatic transfers from your bank account directly to your investment accounts. This takes the guesswork out of it, ensures you stay consistent, and crucially prevents you from accidentally spending that money elsewhere. When you automate, you're essentially paying yourself first. Before you see that money in your checking account tempting you for all other purchases, it's already on its way to work for you. Most brokerage firms and 401k plans offer easy ways to set up recurring investments. It could be $50 a week or $200 a month or whatever fits your budget. The key is to make it automatic. This turns investing from something you think about into something that just happens. Set it and forget it. For the most part, is a powerful strategy for long-term growth because it removes the temptation to procrastinate or get sidetracked by impulse buys, which we always get. It's truly a game changer for building long-term wealth without constant effort. Number 3, do diversify your portfolio. This is like not putting all your eggs in one basket, and it's a golden rule of investing. Diversification means spreading your investments across different types of assets, industries, and even geographical regions. Let's break down some common types of investments. Stocks. You might invest in companies across various sectors like technology, healthcare, consumer goods, and energy. Don't put all your money into just one company, no matter how promising it seems. Index funds or ETFs. These are fantastic tools for diversification. Instead of buying individual stocks, an index fund holds a basket of stocks that represents a market index like the S&P 500. This instantly diversifies you across 500 of the largest US companies with one investment. You get broad market exposure without picking individual winners or losers. Bonds. Bonds are often considered less risky than stocks. Bonds provide stability and income. They can act as a cushion during stock market downturns. Real estate. This can be a direct property ownership or through real estate investment trusts, also called REITs, which allow you to invest in a portfolio of income-producing properties. Metals or commodities. Assets like gold or silver can act as a hedge against inflation or market volatility, though it's important to note that they can also be quite volatile sometimes. So the point is, if one area struggles, others can perform well, helping you to balance your overall portfolio and reduce the risk. A highly diversified portfolio means you won't be overly reliant on any single company or industry. It's about safety in numbers, ensuring that your overall financial foundation remains strong even if one part faces a challenge. Number 4, do start early for compounding power. This is perhaps the most impactful do on your list. The earlier you start investing, the more time your money has to grow, thanks to something called compounding. Albert Einstein called compounding the eighth wonder of the world, and for good reason. So what exactly is compounding? It's the process where your investment earnings themselves start earning money. It's like a snowball rolling down a hill, gathering more snow as it goes, becoming larger and larger at an accelerating rate. Time is truly your greatest asset in investing. The sooner you get started, even with small amounts, the more those initial investments have to compound and become substantial over decades. So harness the power of compounding and start today. Don't wait. Number 5. Do understand your goals and risk tolerance. Before you set out on any journey, you need to know where you're going and what obstacles you might encounter. Similarly, before you put money into investments, you need clarity. First, know why you're investing. What are your financial goals? Are you saving for retirement? This is often a long-term goal, potentially allowing for more aggressive investments early on. If you are saving for a down payment on a house, this might be a medium-term goal requiring a different investment strategy. If you are saving for kids' education, this also has a specific timeline. And if you're thinking about starting a business, a more immediate goal, possibly needing quicker access to funds. Your goals should determine your investment horizon. How long you plan to invest. Longer horizons generally allow for more risk. Second, be honest with yourself about your risk tolerance. This isn't just about how much money you can afford to lose. It's about how much volatility you can psychologically handle. Are you okay with a potentially bumpy ride for higher returns, like a stock market that could drop 20% in a year, knowing it might recover and go even higher? Or do you prefer a smoother, more gradual path, even if it means potentially lower returns, because seeing your investments fluctuate significantly causes you too much stress? These are the questionnaires and tools that can help you assess your risk tolerance, but ultimately it comes down to self-awareness. Your goals and comfort level should always guide your investment decisions. Don't let someone else's risk profile dictate yours. Now those are your 5 do's for investing. Now let's look at the don'ts. Avoiding common investment pitfalls. Now that we have covered the smart steps, let's talk about the pitfalls, the don'ts that can hinder your progress and potentially lead to losses. Avoiding these common mistakes is just as important as implementing the do's. Number 1, don't. Don't panic sell or chase hyped stocks. This is where emotions can truly derail your financial journey. Don't let emotions drive your decisions. Market downturns are a normal part of investing. Historically, markets have always recovered from dips and gone to reach new highs. But panic selling during a downturn locks in your losses. You're selling low, which is the opposite of what you want to do. Think about the dot-com bubble, the 2008 financial crisis, or the early days of COVID-19 pandemic, or even the Liberation Day. Those who panicked and sold often miss the subsequent recovery. Similarly, auto buying into trending or hyped stocks just because everyone else is, or because you saw it explode on the social media. These are often driven by speculation and not fundamental value. Companies referred to as meme stocks or those experiencing sudden unsustainable surges can be incredibly risky, often experiencing rapid increases followed by sharp declines, leaving latecomers holding the bag. Remember the old saying, buy the rumor, sell the news. It's generally wise to stay away from the crowd when it comes to speculative frenzies. Trust your long-term plan, not temporary fads. Number 2, don't invest in something you don't understand. Would you buy an expensive, complex piece of machinery without knowing how it works, what it does, or how to operate it? Probably not, right? The same principle applies to your investments. If you don't truly understand how an investment functions, what its underlying assets are, what its risks are, what it's based on, don't put your money into it. This means asking questions. What is this company's business model? How does this fund generate returns? What are the fees associated with this investment? What are the worst case scenarios? So beware of complex financial products that promise high returns with little explanation. If it sounds too good to be true, it very likely is. Do your research, ask questions, and make informed choices. Don't rely solely on a friend's tip or a flashy advertisement. Take the time to read prospectuses, annual reports, and independent analysis. Knowledge is your best protection against scams and poor investment choices. Number 3. Don't wait for the right time to invest. This ties back to the consistency and dollar cost averaging. Trying to time the market and waiting for the absolute perfect moment to buy at the bottom or sell at the top is nearly impossible, even for seasoned professionals and institutional investors. Studies consistently show that investors who try to time the market often underperform those who simply invest consistently over time. Think about it. To perfectly time the market, you would need to be right twice, once when you buy and once when you sell. The market is incredibly complex, influenced by millions of participants, global events, economic data, and pure human psychology. Predicting its short-term movements is like trying to catch smoke. The best time to invest was yesterday, and the second best time is today. Consistent investing through all market conditions tend to be the most successful approach in the long run because you participate in all the market's movements, riding out the dips and benefiting from the highs. Don't let the fear of not buying at the absolute low stop you from buying at all. Getting started is often the most important step. Number 4. Don't dive in without an emergency fund. Before you invest your money for growth, ensure you have a solid financial safety net in place. An emergency fund is crucial. This is easily accessible cash, ideally in a separate high-yield savings account, covering 3 to 6 months of your essential expenses. Why is this so important for investing? Because investing is for long-term growth, and you don't want to be in a situation where you're forced to sell your investments at a loss if an unexpected expense comes up, like a job loss or a major car repair or even a medical emergency. If you don't have an emergency fund, you might have to withdraw money from your investments precisely when the market is down, locking in losses and derailing your long-term plan. Secure your foundation first. This fund is your financial buffer, giving you peace of mind and protecting your investments from all the life's curveballs. Number 5. Don't invest based on emotions. This is perhaps the biggest battle you will face as an investor. Managing your own psychology. Those red and green tickers blinking on your screen indicating market ups and downs, they don't require immediate action from you. Don't let fear when the market is down and everyone is panicking, or greed when the market is soaring and everyone wants a piece of the action, dictate your decisions. Emotions are powerful and real, but they are generally terrible guides for financial decisions. And especially avoid FOMO, the fear of missing out. This often pushes people to jump into assets they have already seen massive gains, often right before they correct or crash. Remember the saying, the hottest hand in the room is often the one that gets burned. Acknowledging your emotions is important. It's natural to feel anxious when the market dips or excited when it rises. But the key is to take a breath, step back, and make calculated decisions based on your well thought out plan, not your fleeting feelings. Your rational long-term strategy should always trump your impulsive emotional reactions. So, final thoughts for your investment journey. Investing doesn't have to be complicated or overwhelming. By focusing on these fundamental do's and actively avoiding the common don'ts, you will be well on your way to building a strong and resilient financial future. Remember, consistency, patience, and a well thought out plan are your greatest assets. The market will always have its ups and downs, but by sticking to these principles, you can navigate them successfully. So, what are your biggest investing do's and don'ts? Share your wisdom in the comments below. I would love to hear your experiences and tips. Stay wise and subscribe to more Wise Elephant Wisdom.